Effective long-term investing is pretty straightforward. Buy low-cost broad market index funds and hold them for as long as possible. However, it's not completely hands-off. There's one component that needs periodic tune-up and maintenance. Investment pros call this portfolio rebalancing. So the big question is, how do we go about doing this? Unfortunately, just like there is no one way to live life, there is no one foolproof, one-size-fits-all method for rebalancing your portfolio. Each investor must choose a rebalancing method that is appropriate for them at their specific life stage. So in today's video, we're going to review some of the most common ways to rebalance your portfolio. We'll also cover some key considerations, given that rebalancing can create ripple consequences we need to be aware of. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Before we get to the most common ways to rebalance our portfolio, let's quickly review what rebalancing is in the first place and why we even need to consider it in our investing strategy. Rebalancing in its most simplest form is the act of bringing our portfolio back to our target asset allocation. Most often this is required after market forces or life events have changed the percentage of our various asset classes and the segments of those asset classes. And we want to rebalance our portfolio because we ultimately want to control risk. Holding a S&P 500 index fund or a total market index fund is a smart investing move. However, stocks represent just one asset category against other types of asset categories out there. Bonds, real estate, commodities, and even cash represent different asset classes. In order to minimize risk, especially as we get older, we want other asset classes within our investment portfolio to help offset or augment our equities holding. For example, you might want bonds to help smooth your stock volatility. Or you might want international funds to gain exposure to the market outside the United States. And not only do you want these other asset classes in your portfolio, you want to adjust the amount you have of each asset class as you get closer to retirement age, making your portfolio more conservative versus aggressive using different asset classes. A general rule of thumb is that as you get closer to retirement age, you want to hold more stable assets like bonds and cash versus stocks in your portfolio. And this is where investing becomes a lot more like art than science. And especially because past returns don't guarantee future returns, you as an individual investor will need to make adjustments to your portfolio based on your risk tolerance and your comfort level with different types of assets. Therefore, rebalancing brings our portfolio back to a level of risk that we determined was appropriate for us and that we were comfortable with when we first established our asset allocation plan. For example, let's say that I am at a stage where I want to target 70% equity and 30% bond. But in the past few years, the equities market has done really well, so now my portfolio is 90% equity and 10% bond. Now, equities are a much larger percentage of our portfolio than desired, and bonds make up a smaller percentage than called for in our original asset allocation plan. Asset allocation plan that was established with our long-term goals, retirement timeline, and risk tolerance into consideration. So whenever our portfolio that started out as balanced become lopsided, rebalancing our portfolio can bring things back into alignment. Alright, with that said, what are the most common ways we can do this? The first most common approach to rebalancing your portfolio is to sell and redirect. Simply sell portions of high-performing assets and redirect the money towards asset classes that you want to lean into. For example, let's say that you follow a two-fund strategy and you own two simple index funds in your portfolio of $100,000. Based on your risk tolerance, you feel a 70 to 30% asset allocation works for you. So you invest $70,000 in Vanguard Total Stock Market Index Fund, the VTSAX, and $30,000 in Vanguard Total Bond Market Index Fund, the VBTLX. Now, after many years, you decide to check your account and you notice that your VTSAX account has more than doubled in value to $160,000, while your bond fund only increased to $40,000. Your portfolio has skewed to an 80-20 asset allocation from its original 70 to 30 asset allocation. If you want to bring it back to its original asset allocation, what you can do is sell a bit of your VTSAX and purchase VBTLX. In this example, $20,000. Sell $20,000 of VTSAX and purchase $20,000 of VBTLX. This will bring your overall asset allocation back to 70-30 with $140,000 in VTSAX and now $60,000 in VBTLX. Now, although this is one of the most straightforward ways to handle rebalancing, I do want to share with you other methods, given there could be better options. The second most common approach to rebalancing your portfolio is to buy more of the underweighted class. You're essentially purchasing new investments of the underweighted asset class until things balance out. Going back to our earlier example where our portfolio has skewed 80 to 20 from its original 70 to 30, instead of selling VTSAX and buying more VBTLX, what we can do is just buy more VBTLX with new money. Let's take a look at an example. Let's say again that our original $70,000 in VTSAX has appreciated to $160,000 and our $30,000 in VBTLX has appreciated to $40,000. Instead of selling part of our $160,000, what we can do is buy more VBTLX until we get back to our 70-30 target asset allocation. In this example, that would come out to approximately $30,000 more invested in VBTLX. And if we've been adhering to dollar cost averaging, where we've been contributing a set amount to each account at regular intervals, we can just adjust the contribution to direct 100% of the investment into VBTLX until we reach our target asset allocation. The benefit of this approach of buying more of the underweighted class in comparison to selling and redirecting is that we mitigate tax consequences. If we're rebalancing a tax-advantaged retirement account like an IRA or 401k, we don't need to worry about tax consequences because you don't realize taxable gains within those accounts. However, whenever we sell investment from a taxable account, we need to understand that there could be capital gains tax. Now, there are ways to minimize taxes when rebalancing, such as tax loss harvesting, a strategy where we sell investments that have decreased in value, then use the losses to decrease our income taxes. However, there are strict rules we need to follow as well as limitations, so we should consider all of them when rebalancing. Alright, the third most common approach to rebalancing your portfolio is really relevant when you're in your withdrawal phase, most likely when you're in your retirement, and that is to withdraw first. Just think the complete opposite of method 2. Instead of buying more of the asset class you want to increase, you spend first the asset class you want to decrease. You're essentially using your voluntary or required distributions from your tax-deferred account to help rebalance your portfolio. Going back to our earlier example, when our portfolio has skewed 80 to 20, $160,000 in VTSAX and $40,000 in VBTLX, we can just withdraw from VTSAX until we reach our target asset allocation. If our VBTLX amount remained flat at $40,000, then when we spend down our VTSAX fund to approximately $90,000, we will be back to the 70-30 asset allocation. Now, I know I covered a lot of technical terms and numbers here. So if all these talks of rebalancing and asset allocation are giving you a headache, no worries. Let me share with you one more method that could alleviate some of the headache for you. The fourth most common approach to rebalancing your portfolio is actually not to do them at all. Now, you must be asking, how is that even possible? Black rebalancing magic? Unfortunately, no. One is by having a super simple investing and asset allocation strategy. My favorite is a two-fund strategy that I alluded to earlier in this video. When you have a two-fund strategy, as the name implies, you only have two funds in your portfolio, an equities fund and a bond fund. And when you're in your wealth accumulation phase of life when you're in your 20s, 30s, or even 40s, you can get away with having literally just one equities fund like the Vanguard Total Stock Market Index Fund, the VTSAX. Yes, 100% of stocks is considered a very aggressive investment allocation. However, when you're young, you should be. You have decades ahead of you, and market ups and downs should just be noise to you. You should be excited for market dips during this phase because there are great buying opportunities to scoop up more shares at a lower price. And the nice aspect of this strategy is that you don't even have to think about rebalancing until you get closer to retirement age when you will start adding a bit of bonds. Now, if that is even too complicated for you, I have another recommendation that can alleviate your pain of rebalancing. Introducing target date funds. They're sometimes called target retirement funds or life cycle funds, but the premise is the same. Unlike a do-it-yourself portfolio, a target date fund will rebalance the asset allocation of the portfolio automatically as you get closer to retirement age. The basic investing philosophy is the same as a DIY portfolio, but it makes investing even easier. You can think of it as the poor man's financial advisor without all the downsides of actually having a financial advisor. If you want to make good investment decisions, but don't have any desire to learn about investment strategy or portfolio rebalancing, this one fund will literally be all you need for the rest of your life. It has automatically built-in diversification because it holds low-cost broad market index funds, and it automatically adjusts asset allocation as you get closer to retirement age. As I mentioned earlier, a general rule of thumb is that as you get closer to retirement age, you want to hold more stable assets like bonds and cash versus stocks in your portfolio. A target retirement fund does this for you automatically, making your portfolio more conservative versus aggressive using different asset classes. As an example, assuming that I want to retire when I'm in my 60s, my Vanguard specific target retirement fund would be a Vanguard Target Retirement Fund 2045, also known as VTIVX. Alright, now that we've covered the why and the how of rebalancing, let's look at some other items we want to consider. One is to rebalance your tax-deferred accounts first whenever possible. And this is because of tax consequences. As I mentioned earlier, if you're rebalancing a tax-advantaged retirement account, you don't need to worry about tax consequences because you don't realize taxable gains within those accounts. However, selling investment from a taxable account could put you on the hook for capital gains tax. Two is to minimize taxes. You can do this by using tax loss harvesting in your taxable accounts as part of your rebalancing strategy. Or better yet, avoid capital gains taxes by using cash contributions to purchase assets that bring your allocation into balance. Three is to assess your target asset allocation at most once a year. Some say you should do it more frequently. However, according to research from Vanguard, there is no optimal rebalancing strategy. Whether a portfolio is rebalanced monthly, quarterly, or annually, portfolio returns are not markedly different. And I feel like checking our investments too frequently might actually do more harm than good in achieving our long-term goals. Fourth is if you want a super simple solution, really consider simplifying your investment strategy by either pursuing a two-fund portfolio or a target date fund that automatically handles the rebalancing chores for you. That's it, guys. Thank you guys for watching. If you'd like to learn more about target date funds, or sometimes called target retirement funds, to really simplify your investment, check out my video here. Until next time, all the best.